All right. Hey, this is Colin Nathan Alim, the real estate boy, and welcome to Fund My Keys podcast, where we discuss essential financial tools and resources for first time homebuyers. So, in this episode, we're going to dive into the world of down payment assistance programs with expert mortgage lenders, breaking down how these programs work, who qualifies, and how they can help you get into your first home with little to no money down. So, whether you're ready to take that next step or just starting to explore your options, this episode is packed with actionable insights to help you make your home ownership dreams a reality. So today we have Jeff Vilk from Fulton Mortgage. Welcome, Jeff.
Thank you. Pleasure to be here.
So me and Jeff have worked on a couple of first-time homebuyer down payment assistance program um, deals, and I wanted to bring him through. Very sharp mortgage lender, and again, this podcast is set up so that I can bring you the mortgage lenders from banks or mortgage institutions where they can break down these down payment assistance programs. So, Jeff, why don't you tell the people a little bit about yourself?
Sure. So as you mentioned, I work for Fulton Mortgage Company, a division of Fulton Bank. I've been specializing in first-time home buyers, specifically low down payment and grant opportunity mortgages for almost my entire career. So it's definitely something I believe I'm well versed at. Been in the industry for a little over 15 years now. I think closer to 18. I've been saying 15 years for a few years now. So, and I primarily focus on the Philadelphia metro market. So that's really where the bulk of my business comes from.
And I think it's important to point out that there are many real estate agents, and I mean there are a ton of real estate agents, like one on every corner, and there are a ton of mortgage lenders. But it's important to have people who specialize in down payment assistance because it is like another world, and if you don't deal with it day in and day out, you may have people that can do it, but are they getting you the best rate out there? Are they getting you the best programs out there? Because there's not one particular place that you can go to and see, okay, which one is best for me? And some AI computer spits it out. So, got some questions for Jeff.
Yep.
I'm gonna throw them at him and see what he comes back with. So, Jeff, let's hop into it, man. Um, First, can you start by explaining what down payment assistance programs you have at Fulton Bank and how they work, in particular for first-time homebuyers?
So unique to Fulton Bank, we do offer up to $5,000 in down payment and closing cost assistance. It's based on two factors. One, your income helps you qualify, as well as there's certain information about the location that you're purchasing the property. So most places that offer unique down payment or closing cost assistance, they're looking for primarily your income first, and then they're looking for where is the property located. So like I said, we're up to 5,000, and I'd like to add in there that I'm also well versed in all of the available grant opportunities in Philadelphia, which is also very vast. I did also want to add the comment on, you want to work with lenders that know the programs, because it becomes like a Jenga puzzle. If you work with a lender who's trying to do something that's not familiar, for the same as if you're working with a realtor
Right.
who's not familiar with your profile and where you're trying to buy, um, that same scenario that could close might end up not closing.
Right.
So I thought you said it very well. I always like to use that Jenga puzzle. It means like if you go to a lender that qualifies you and it doesn't work, meaning they say like, hey, I'm going to get your buyer an extra $5,000, but I'm wrong. Well, now you got $5,000 you got to make up, and that $5,000 might not be available. And that, I believe, is the most dangerous part of dealing with first-time homebuyers and an unqualified loan officer.
Gotcha, gotcha. Okay, so just to reiterate, and we'll get in more to about the local programs and the state programs, but right now, as far as Fulton Bank itself, the program that they have is up to $5,000 for first-time homebuyers.
We also have, not a grant, but we also do offer what we call a combo loan.
Okay.
To qualify, you can do 100% financing,
Mm,
which means that at that point, you just have to be responsible for the closing costs.
okay.
So a lot of people know that if you do an FHA loan, you need 3.5% down. If you do a conventional loan, it could be as little as 3% down. The combo loan, I think, what I call my emergency program. Say you have a borrower that hasn't qualified for a grant, it needed to be done up front. That could help bridge the gap and make a house more affordable. Just to throw a dollar amount to a combo loan, If you're buying a $200,000 home, a conventional loan would require a $6,000 down payment. If you do the combo, that eliminates the need for that additional $6,000. The other beauty of the program, the rate on it is the same for the first and the second.
Mm,
So, and that way there's
okay.
no mortgage insurance, because everybody knows if you don't have 20% down, there's no mortgage insurance.
All right.
We have affordable products. One of the affordable features of this product is no mortgage insurance. So I call that my emergency loan. So when I get that phone call from a realtor that says, we're in trouble, buyer doesn't have enough funds, the other lender didn't qualify them properly, is there anything you can do to help? That's my go-to, is the 80/20, the combo loan.
Gotcha. A combo loan. So it's two loans. It's
It's
one
two loans with
loan.
the exact same features, meaning like
Okay.
if the rate was 6%, it's
Mm-hmm.
6%, 30-year fixed on both. And just a
Okay.
little reason why, we're taking on 20% of the risk. So that's the
Mm-hmm.
reason people say, like, I need to put 20% down, or
Mm-hmm.
I don't want to pay mortgage insurance. We're doing two loans. We sell one to Fannie or Freddie. We service them both, but we keep 20% and we take the risk to help the buyer, to try to help with the bridging that affordability gap.
Okay. Nice. Nice. Now, in your experience, what are the most common mistakes that first-time home buyers make when they're trying to qualify for down payment assistance?
Um, I would say, like, um, when you want to apply for a mortgage, you want to put your best foot forward. You really
Mm-hmm.
want to know what's on your credit before you start applying. If you're paying things off or paying things down, because once we pull the credit, like, you've been graded at that point.
Right.
If you know that you're paying stuff off to get your score up, you want to kind of do it all in advance just to get yourself in the best position that you can. You also want to make sure you have all of your documentation readily available, meaning like if it's on the computer, ideally in PDF format, labeled, because lenders are going to ask you for your financials. So we can pull credit, but they might ask you for your tax return, your W-2s, your pay stubs, bank statements. You want to make sure you have access to all these items. Otherwise, it's going to cause a huge delay in your process. Or it's going to cause a lender to misqualify you because they didn't see your documentation in advance. And then if you get on the contract, God forbid later, you provide your documentation and find out the information that you provided to the lender was incorrect. So now that we've documented it, it might cause you to be not as qualified as we originally thought. So preparing for the application. Also, I will say this, I want to earn everybody's business. You want to shop around. People should know that if you have a lender pull your credit for the next 30 days at least, you could have multiple lenders pull your credit to shop around. A lot of first-time home buyers get swayed from doing that because they're afraid, like, if their credit has already been marginal, they don't want additional hits to their credit.
Right.
So they'll tell you, I don't want all these people pulling my credit. It's not like a car dealership. So I recommend you shop around because everybody has unique product sets. One might fit you better than the other. And by not shopping around, I feel like you're doing yourself a disservice. So, because people with good credit always shop around.
Right. Right. And all lenders aren't the same. Uh, all officers aren't the same. So I mean, you got to have some type of rapport with the person, and you do want to get somebody. Also, I'll speak on this. You want to get somebody that cares, and Jeff definitely does care, because there's a lot of moving parts just in this transaction. So if you don't have somebody that does care about your situation, then you could kind of get lost in the sauce. So I will say that. And like Jeff said, as far as shopping around, that's something that I definitely advocate for, as far as shopping around and trying to get the best rate, trying to get the most money possible. Because different lenders have different programs where they want different borrowers. So some may just be focused on grade A paper loans, and some may like the C loans. So it really all depends. So that has me jump into my third question, Jeff. Many of our listeners are young professionals with good jobs, even some have high paying jobs, but they may struggle to save for down payment. So how does Fulton Bank's down payment assistance programs help with maybe middle to high income buyers?
It's a difficult broad stroke answer, but I'll give you, like, let's use Philadelphia as an example.
Okay.
The area median income, you could be at about 87,500 of qualified income. What that means is, like, let's say that professional has an $80,000 salary, but with bonus and incentives, they could be at 100,000.
Mm,
Our affordable products goes off of qualified income. So if you did the combo loan, for example, we would use the 80,000 as long as it accomplishes their goal. Does the 80,000 help them buy the house that they want to buy? I have another person whose salary was over 100,000, so that kind of eliminates the affordable product part. I happen to be very well versed in bond loans. So for the people that know what a PHFA loan is, Pennsylvania Housing Finance Agency, that limit is 137,000. That could also come if you have a 660 credit score or higher. That also comes with 5% as a forgivable grant, 5% of the sales price. So again, $200,000 purchase price, that's 10,000, and there's no cap as long as it's in a qualified loan amount. So that's knowing those resources. Like you said, talking to the loan officer that can put them in something where they can still get a more affordable product as opposed to being pushed into just a conventional loan where they need 3 or 5% down plus mortgage insurance. I'm hoping this is a good example of like why that loan officer, as you mentioned, matters. Somebody that knows how to all of the options that are available to make sure that that person, even though they don't get, and this is interesting, it's like a reverse category. So it's like you have a low down payment or low credit score borrower, everybody defaults to FHA. I know you've heard that phrase, FHA, FHA, FHA.
Right.
There's ways to get them out of that. But the same thing in reverse. Somebody might make, like you said, a young professional makes good money, but still needs a little bit of help. You have to work with a loan officer that knows how to put somebody in a PHFA product to get that, accomplished. So that would be my long-winded answer to that. So.
Yeah, no, definitely there. And I think what Jeff was saying also was that there are a lot of products out there. There are a lot of products. You have, I always say there's kind of 3 tiers, and we'll get to tier number 1 and tier number 2, or tier number 2 and tier number 3. But tier number 1 is the proprietary product. Whether it's a bank or whether it's a mortgage lender, they'll have first-time home buying programs there. But then you have local programs, state local programs or city programs, and then you'll have state programs also. But again, we'll get to that. My next question is, can you, Jeff, can you walk us through the process of applying for down payment assistance programs at Fulton Bank? What should a buyer expect in reference to timeline and requirements?
Sure. Let me use me as an example. So the average person will apply using a mobile app. You can enter all your information. You want to make sure that you have, again, your information entered correctly, name, address, date of birth, social. Once you're done the application, you will get the option to directly upload your financials, which we discussed before. You want to have ready, not that you'll need it, but you want to have ready the last 2 years of your financials. Federal, not state, federal tax returns, your W-2s. If you've had multiple jobs, you're going to need all of them, because we have to create a 2-year work history, right? So that's something you want to keep in mind. Your pay stubs. If you get direct deposit, you don't see them, you want to be able to access them and download them offline. You want to have access to that. Usually, once this is provided, I usually give a turnaround time of about 24 hours. It's really not that complicated once the information's in the system. The things that cause problems is the delay between application versus supporting documentation. That's really what causes delay. And whenever I hear from a realtor call and say like, oh, nobody's getting back to my borrower. Everybody's going to get back to your borrower. Something went wrong in that equation. Documents weren't provided. Too much time went by. Lenders can get busy too. They might work on the more recent applications where if you applied a week ago and then you start, oh, I sent one pay stub on Monday. I sent a W-2 on Thursday. It's like that creates a problem. The more concise and the faster you can upload your documentation, the faster you get a turnaround time. That usually buttons up concerns. Making sure, I will add this because we haven't touched on it yet in terms of what you were asking in terms of be ready for application. There's additional stuff outside of employment, such as child support payments, whether you make them or receive them. That's a factor. You might receive Social Security for yourself or on behalf of someone. That could be qualified as income. So these things that we might not see, and if you don't tell us, and if the loan officer doesn't ask you, again, you might not be qualified properly for good or bad reasons. One, on a bad reason would be if you didn't tell us that you were getting Social Security and you're in an income-based product that was considering all the income in the household, that might take you over the limit and you might no longer qualify for that special program. Same thing in reverse. You want to buy a home for, say, $300,000. In your head, you're thinking, okay, I make X amount of money, but if you didn't tell the lender that you get child support, that you get Social Security, these additional income factors, then you might also, again, not be properly qualified for the amount that you were looking for. So making sure that you disclose everything, and I'll always lead with this. At some point, the lender will find out everything. The question only becomes, when do they find out?
Right.
We'll see if there's a court order against you. We don't do it day one, but in the
Right.
process, we'll find out. You don't disclose it, again, whether you receive or pay, it's a problem. I've also seen people that get qualified and on the pay stub, if you have a garnishment. As a loan officer, I'm used to it because, again, when you work with so many first-time homebuyers, I look for the red flags.
Mm.
Believe it or not, my goal is to deny the loan. If you get by me, you're going to closing usually.
Right.
Not because of something I did, meaning like I look for the things that could cause a problem, so we address it up front, not when you're in the contract, not when you've spent money in a home inspection.
Right.
That's why you have to ask those additional questions. So making sure that you deliver all of that information. And for example, if you do collect child support, you have to have the court order. That could cause delay because, again, without it, you're not properly qualifying the borrower. So the more documentation you have up front, the easier your process will be. And then you'll actually be able to see, give you an example. You apply with me and I ask you a certain set of questions. You go to another lender, they don't ask you those questions.
Right.
That should tell you something, how prepared you're going to be.
Definitely. And that's why your lender definitely matters. And because what Jeff is saying is basically not trying to waste anybody's time. Because that's our most precious thing is time. So to take you all to give you a pre-approval and to have you go out, but on the back end you don't qualify. I mean, when you learn that you don't qualify, now everybody's mad. Okay, so I think that's what Jeff is talking about as far as doing the due diligence, just so that we can kind of say, okay, is this worth doing or whether it's not. So and some of these questions you may be going over the same thing over and over and over, but again, we just want to ask it just to make sure that everything's clear. So, Jeff, my next question is: what are some of the key eligible factors that first-time home buyers should be aware of when applying for these programs?
Believe it or not, it's the usual three that you would be looking for to when you apply for a loan. Your credit.
Mhm.
So to give you an example of a credit scenario, you have to qualify for the mortgage too. So being eligible for an income-based product is fine, but the credit still has to qualify. So making sure that your credit, use an example, PHFA, to use their grant, you need a 660 credit score. Most other affordable products like conventional FHA, like for example, Fulton Bank, you need a 620 or higher. So you want to pay attention to your credit score. The income, again, making sure that all of the income is being utilized or at least informed, like you're informing the lender, here's all the income. Some of them might say household income. What that means is they're not just looking at you, they're looking at any other adult in the home. So if you ever hear the word household income, again, just to be more specific, like Philadelphia has that $10,000 grant, up to $10,000 grant, that's household. So they're going to be looking at everybody in the house. So if you don't disclose it and they find out later, for example, like, it's just me, there's nobody else in here, but your tax return shows somebody else, that's something to be mindful of. Last but not least, some have asset requirements. So meaning like if you happen to be one of the borrowers that have a substantial amount of liquid assets, not retirement funds, liquid assets, they might have an asset test where they're going to say like, you can't have more than X amount of money after closing. Because again, they want to make sure that there's a need, not just that you're eligible because of income or credit. If you have too much in assets, they might say that, you have too much left over, like you're not eligible for the program. So believe it or not, those are the three factors. And again, the sooner the lender sees all of those three factors, the better you are being qualified.
Awesome. Now you touched on credit, and that kind of goes to my next question is for buyers, who have credit concerns or student loan debt, how do those factors impact their ability to access down payment assistance?
I mean, let me start with student loans. That's always the hot topic. Student loans has a few variables. Student loans are reviewed differently depending on the mortgage product. It's not the same across the board. During the CARES Act, when we had COVID, everybody was in the forbearance. The problem is like if you're on an income-based repayment, meaning you applied, you have a federal loan, you applied based on your income, regardless of your balance, they're going to tell you you're obligated to pay X amount of money. So depending on that amount, again, each agency, meaning if it's a conventional loan, there's Fannie and then there's Freddie. Those are two conventional loans. All lenders use the same one. So it's not just me. All lenders use the same one. It's Fannie and the Freddie. They have their rules. FHA has their rules. So making sure that, one, if you're eligible for an income-based product, that you've applied, you're not just in forbearance or deferment. Because again, then they're going to use either 1% of the balance. And to be honest with you, most student loans are not $5,000. So if you have $50,000 in student loans, that's a $500 hit against your debt.
Okay.
$500 is like a car payment. And then again, if you go Freddie or FHA, it would be half that, like 0.5%. That'd be $250 of money that you're not paying, but your lender is counting it against you. And that also sometimes causes people to get frustrated. It's like, I can afford a higher payment, but I'm like, but we're using a debt against you that you haven't even paid yet, but we're required to use. Again, not because the bank decided, because the people that we sell to, like again, Fannie, Freddie, and FHA, that's what they require. And again, VA has different loans, USDA, if you get into those. So making sure that your student loans are taken care of, you want to do that again first. You don't want to start funneling around with it. There's also, like I heard, student loans might be a little bit more complicated. I think they're in litigation now to even accept any new income-based repayment products. So there was an injunction put on them. And in terms of debts, you want to also make sure that we're qualifying you off of the minimum monthly payment, not what you actually pay. So when we look at a credit report, we're paying attention to whatever's reported on your behalf of the minimum monthly obligation. We're not qualifying you based on, like, if the minimum payment says $35, you happen to be paying $100. When the lender does the calculation of your debt to income, your debt on your credit report versus your income, they're only paying attention to what is being reported. And the number one thing that I think is becoming, I want to say, a phenomenon are car payments. Car payments have gone off the chart, illogically ridiculous. Like numbers I've never seen. And it's just like, the concern is, like, if home ownership is your goal, controlling that decision before applying or buying a car with a payment that you know for yourself is just way too high. You know,
Right.
the payment's too high. If home ownership is the goal, that has to be taken care of. Like that, you either hold off, do whatever you have to do, because once that car payment is on your credit report, it's on your credit report. I will say one thing. This isn't discussed enough, but this is like a secret. I don't want to say a secret, but it's just not told to people enough. If, say, for example, and I never ever recommend anybody co-sign for anybody, but if somebody else, like you helped a family member, you helped a friend, and they're paying the debt. I bought a car. I helped my friend buy a car. Payment's $500 a month. If you can document 12 months that person made the payment themselves, they didn't give you money and then you paid it. Out of their own account, they can provide 12-month payment history. Then we can exclude that debt from it. And that includes most installment debts.
Oh, wow.
That's something to consider. But that's see that face. That's why, again, when you have to dig down deep and you're like, okay, how are we going to make this work? You got to ask those additional questions. Does somebody else pay this, or why are there 2 cars in your credit? Ask those additional questions. But if you're a borrower, and let's say you're not doing it the right way now, start doing it the right way now. Start telling the person, listen, you got to pay it yourself. Stop giving me money. Pay the debt yourself, because my goal is to buy a home in the next year. So
Interesting, because I have a person specifically that they have a child, and that child took out a car note and she co-signed for it. And now she's been not, I've been trying to get her to buy a home for like 2 or 3 years now. And this is the one thing that's holding her up. Speaking about cars, I run into a lot of people that have repos on their credit. I guess, how's that handled? And if it's after what, 2 years or 5 years, lenders don't really look at it. How does that play a part on a person's credit?
I mean, the way I always do it, the system will tell you. When we run it through, it'll tell you if there's any action needed. It's not because we don't really do that much in manual underwrite. If it's recent, it's going to destroy your credit. But like you said, if it's been on there for a year or two, the system will tell you if it's FHA, for example, and it's over $2,000, we'll have to apply 5% of the balance as like a monthly payment. Just to give you an example. Conventional, the system will tell you, it'll identify it, and then it'll tell you if there's any action or if it's causing a problem. But it's not a flat answer like you're just done. It's not.
Okay.
You're not you're not disqualified just because you have it. I also recommend don't do anything with it until you apply and find out if it's stopping you before you waste resources. Again, I'm not telling anybody not to pay off debts.
Right.
Before you make an action, you should have a plan in place. Is it stopping you or not? Because if you take up a couple $1,000s from your already reduced savings, you're kind of like, did it help you? It might not.
Right.
You know.
That's a good point. That's an excellent point. Again, just to reiterate it, is that if you do have a repo on your credit, let's apply for the loan first. Let's apply for the pre-approval first. Let a lender look at it and then make the determination on what needs to be done. Correct?
Right.
Okay, great. All right. Well, moving on. We know that Philadelphia has its own unique housing market, and um, are there any specific programs or grants available through Fulton Bank that cater to buyers in this region or the surrounding counties? And then also let's talk about that tier two and tier three as far as um, grants or programs on the city level and also grant programs on the state level.
I mean, I will say they're vast, so it's hard to kind of. I mean, I can do a run through, but
Right, right.
let's
Let's
start
get a
with the
quick
mortgage
run through.
products for Philly. Philly, the reason I think Philly is unique is there's still a good amount of areas where when I was referring earlier about like where a property is located, there's a census tract, right? Census tract is if you ever see census workers coming around knocking on your door, hey, who lives here? How many people? What's the income? Blah blah blah. What they're really tracking is like what kind of neighborhood, what kind of demographic, how much income is being brought in. So let's say it's in a low to moderate income census tract, right? So we look up the property, it'll tell us if it's low to moderate. For example, Fulton Bank has a product we call Homebuyer Advantage. It's a 3% down, no mortgage insurance. But if it's in a low to moderate census tract, you could make $1 million a year and qualify for 3% down with no mortgage insurance. I also like to put out there, because believe it or not, this is also a misconception. Some people do believe mortgage insurance protects the borrower. It does not. Mortgage
Right.
insurance is something you want to avoid at any cost, because you're paying for insurance to protect the lender in case you default. So if you have a product and you're comparing two different deals, seeing mortgage insurance shouldn't make you say, well, it's a little more expensive, but I'm protected. It's not for you. That's for the bank. But that's something, like I said, in Philadelphia, depending on the areas, if it's in a low to moderate census tract, that might be the reason. So if you applied with me and you applied with somebody else that doesn't have the same program, and you might make 150,000 a year, you're going to be surprised. And I might say, you can do 3% down, no mortgage insurance if you buy this home. And then you go to another lender, they're going to say, well, you can do 3% down, but you're going to pay X amount of mortgage insurance and the rate's going to be higher. That's why, because that unique product that we decided that we're going to provide as an affordable product, because we're trying to encourage home ownership in certain areas. So we don't want to limit it to the income part. The second part of your question, the grant opportunities in Philly, for example, Urban League Housing Organization has $1,000. If you're buying in certain zip codes, you have a certain income. We need to know what that is. The Philly First Grant, that's 6% of the sales price up to $10,000. You have to do the housing counseling up front. You can't sign a contract and then try to go through counseling. Knowing that's important. If you're buying in Bucks County or Montgomery County, both of them have pretty good one. I think Bucks is 10,000, Montgomery County is 15,000. Again, if you do the counseling up front, this is the part where you need to prepare. So if you meet with a realtor, you meet with a loan officer, and you want to buy in a certain area and you're income eligible, that's where you need that guidance to make sure that you go to the right place. Delaware County has its own. I think it's up to 6,000. Again, you have to do the counseling up front, make sure that you're eligible. We work with all of those grants. So all of our products, as long as they work together, we're pretty flexible working with all of these opportunities. Also being well versed in it. So that way, if somebody does apply and they fall short and they need the grant help, that loan officer or that realtor should be the one to help kind of guide you to the right resource to make sure that you take advantage of it. And what else? Is there anything else unique in Philly? There's also another, this is more of like there's a $2,500. It kind of got popularity when Fannie and Freddie made that announcement. If you make 50% of the median income, so like for Philadelphia, I think it's like 57,000, you could get $2,500 under credit. So if you do a conventional loan product, so Home Ready or Home Possible, that's an additional $2,500 you don't have to do anything for. So again, if your qualified income is at 50%, you're going to get it. The interesting thing about it, if the loan officer doesn't know that you're eligible for it and they don't put it on the file, you're not getting it. It's not an automatic thing. It's like, and as a sales manager, I've seen, and I've had a lot of loan officers reach out to me when they're trying to make something work. And I'm like, you didn't include the $2,500. That would have helped bridge the gap. Or you could use it to buy down the rate to make the home even more affordable. Like there's things you could do with it. But again, if you go to the wrong loan officer, you might be doing yourself a disservice and not getting $2,500. That's money.
Right. And Did you want to touch on the because you talked about it before, but the state product as far as the PHFA and the KFIT?
So PHFA and KFIT is phenomenal product. Done with the wrong loan officer, it's a disaster. But to do it, you got to make sure that you're asking for the right things up front. But what it is if you have a 660 credit score or higher, PHFA will give you a KFIT grant. What the K stands for Keystone, the way to remember it. FIT is forgivable in 10. So in 10 years, it's fully forgiven. 10% is forgiven per year. And again, it's 5% of the sales price. But again, if you're going to use a bond program, right? PHFA is a bond program. You get a good interest rate with it. But you want to make sure you're working with a loan officer that knows how to do the program, meaning not just that the institution is eligible to do it, that the loan officer knows how to do it. Because the one thing you always have to remember, a listing agent, the person that's representing the seller, will usually call the loan officer. Hopefully that loan officer answers the phone. That's step one. Step two, hopefully they can instill confidence and listen, it is a bond loan. Let me tell you why we're not going to have a problem with it. And you start addressing the steps you need. The easiest ones are you have to make sure there's a termite cert, right? You have to do a termite whether you want to or not. It's required on every file. There's forms that need to be completed. The sooner you complete them, the smoother the process is. And then making sure that you collect all the necessary documentation up front. Loan officers that don't do that, the process becomes very drawn out. And I will say this, currently PHFA is on a 1-day turnaround time.
Wow. That's
one
crazy.
day. Remember, it was 30 days a couple months ago. They're down to 1-day turnaround time, which means there's really no time to lose. So there's no downside to doing a PHFA loan. So.
Right. And so just so people know the significance of that, when you're going through processing, you go through a mortgage underwriting process, but with some of these grants, they have their own processing. So it adds time on to when your file is actually going to be done and when you'll actually close. So again, that's why it's pertinent that you work with a loan officer that knows these things, because not too long ago, PHFA was at a 60-day turnaround time. And so that means that if you wanted to buy a home and you went to the seller and you put an offer in, usually they want 30 to 45 days. That's usually the turnaround time when you're buying a home. But if PHFA, if their turnaround time is 60 days, and then you add that on top of the turnaround time for the mortgage, now you're talking about 2 to 3 months, and sellers usually don't want to wait that long. So that's why, even though I'm sure that they try to process it fast as possible, sometimes it bottlenecks. So that's why it's important to work with a loan officer or a real estate agent who has their ears to the ground dealing with these down payment assistance programs, because they're programs and they're ran by people. And sometimes they have hiccups, sometimes there are changes, sometimes they close, like the first front door. It closes every year. So you can think that you have this program and you're counting on this money, and now the program closes and now you don't have the money. So it's super important for you, again, to work with individuals that work with these type of programs. So the next one is going to be a softball for you. But can you share any success stories of first-time home buyers who use some of the down payment assistance programs through Fulton Bank or through the other state or local programs? And I guess what made their journey successful?
I mean, working backwards, what made the journey successful is the preparation of the buyer. So if you ever track let's use social media as an example. Whenever you see people saying like, "Oh, this person was able to buy the home with little or no money out of pocket," that means they made the stars align. You had to have done the research. You have to have done and contacted the right resources to make sure that everything you were eligible for, you got. And I'll take one that's not even mine. It was one of my loan officers. He stacked 5 different grants. 1,000 here, 1,000 here, 2,000 here, 1,000 here, plus the Philly First Home. I mean, I never seen anything like it. I mean, that took work, but what the borrower did was they reached out to their employer. They got an employer grant. Another agency that did a match for the grant, meaning like one place gave 2,000. They matched it with another that gave them 4. Another one, the Philly, that we were talking about, Urban League. Urban League had the additional 1,000. They qualified for that VLIP that I was telling you about. That was an additional 2,500. Plus the Philly First Home, that was 6%, up to $10,000. I mean, there was so much in the pot. We had to find a way to buy down the interest rate as much as we could to use up funds. They bought a home warranty. But again, they did the research before they went under contract. This isn't something where you get on the contract, you start scrambling. Oh, I need to come up with more money.
Right.
The more preparation you do, the more research you do, the more opportunities you'll find. Like I said, most people don't even know if you go to your employer. You work for Drexel, Temple, Penn, you work for hospitals. They have grants to help people. They want employers to live in the area. You can't buy it and move away. You got to, if you they'll help you with down payment assistance,
Right.
utilizing those resources. I've helped people, like I said, with the 80/20. When somebody went to another lender, promised the world, they couldn't do the loan anymore. Now you're short on funds. I don't have time for them to go to housing because they're already under the housing council because they're already on the contract.
Okay.
Using my 80/20, help people complete the transaction because again, you're eliminating the need for that down payment. Plus, you're getting some qualify for that VLIP. And usually, aside from credit, cash to close is the biggest barrier to entry for people purchasing a home.
Right.
That's why there's so many grant opportunities. So the agencies that are paying attention to what is stopping somebody from buying a home, obviously credit is one, but cash to close savings. And like you said, if you have young professionals who might make good money, doesn't mean they're saving a lot. Doesn't mean they've had enough time to put a lot of savings together. Doesn't mean they're not eligible to purchase a home, but getting help for the down payment. So I've used the 80/20. I think that's worked well when First Run Door is available. That helped a lot of people. Philly First Home is something I've seen a good amount of use from. One of the other ones, the unsung heroes, is PHFA, that KFIT we were just talking about. 5%. If you're doing a conventional loan, you need 3% down. Now keep in mind, you're getting 5% as a grant. 3%, that covers your down payment. You have 2% left over to help cover some of the closing costs. That's what makes affordability happen, right? You have some loan officers that don't even want to touch PHFA. So even if you're eligible, they'll be like, I'm not doing it. Here's what I can
Oh,
do.
wow. That's crazy.
I mean, because you got to realize there's really nobody over the top that's making sure that a borrower's in the right program, which is one of those,
Exactly.
like, I'm participating in a lot of housing organizations. We talk about this a lot.
Hmm.
Affordability. It's like, one, you'll see places that deny loans unnecessarily, right?
Mm.
There's something like what I consider really specific. Affordability for a conventional loan, right? So let's talk about FHA and conventional loans. As a realtor, if you have to present an offer to a seller and one's FHA and one's conventional, which one are you
Mm.
going to give? Assuming everything else is the same, sales price is the same.
Conventional all day.
Because FHA has requirements for the property. Human beings are lazy. Nobody wants to make repairs. FHA might require more repairs that might be, pertinent to that property.
Mm.
On a conventional loan, again, there's two ways to run conventional. There's Fannie and there's Freddie. What I've realized, because I specialize in first-time home buyers, I specialize in people that are not necessarily perfect credit. Freddie, right, running it through Freddie has become much more relaxed than running it through Fannie. Why that's important? Because not all lenders run Freddie.
Mm.
But if I have the opportunity, because again, it's not a matter of like, I want to give the best deal. You still have to have your offer accepted. So, I mean, yeah, I could go FHA, but if I can get you into a product and payment might be higher, I'm not going to say it's better than FHA, but you still have to have an offer accepted.
Right.
And if you ask a realtor and they say, like, listen, when you're driving around with somebody with an FHA offer, it's a little bit frustrating sometimes when you're making multiple offers and you keep getting beaten because they keep taking a conventional offer.
Right.
That might be the reason that you can turn your luck around and get a next one accepted if it's a Freddie Mac Home Possible loan. But I paid attention to that, and I've seen borrowers who came to me FHA approved. I know why they're FHA approved, and then I give them the conventional approval. Then the realtor's like, how did that happen? Because I knew how to run it through a conventional option. That's a Jeff Vilk thing. That's not all lenders are the same. That's a loan officer specific skill. There's only a handful, in my opinion, of good loan officers in the market. I mean, a handful. So it's not the lender. You can go to the same loan officer. I'm sorry, you can go to the same institution, bank, or broker.
Right.
Go to two different loan officers, you'll get two different results.
Right.
That is the most terrifying part of loans, in my opinion. That you can be qualified differently. It could be income calculation not done properly. They didn't pay attention to your student loans. They didn't ask you the additional questions. Again, same institution, two different outcomes. Absolutely terrifying.
And that happens a lot of time. People will come to me and I'm like, okay, are you pre-approved? And most of the time, if they do say yes, a lot of times they went down to their local bank and they're just like, okay, yeah, I went down to my local bank. And I'm like, or they'll ask me, well, if I ask them, okay, are you pre-approved? And I said, no, okay, you need to get pre-approved. They're like, okay, well, I'll go down to the bank. I've been banking there for 20 years or 30 years. And they think, okay, they took care of me on my checking and savings. They'll take care of me on my mortgage too. And I'm like, it doesn't work like that. It really depends on the mortgage officer, your experience with that particular institution, because a lot of times if you just go down to the bank, they may give you a number to some call center in Idaho. and that person is going to treat you like a number because you are a number to them. They don't know you, nor do they have a relationship. For example, um, the people like you that I have a relationship with me, if I don't make any money out of the deal, but I know that this person is going to take care of you, and this person not has a responsibility, but they want to do good because of the relationship. So it's better to go that way versus just going on your own and just picking a phone up, and now that person doesn't know you from Joe, and they're just like, yeah, I can give you a loan. This person may have no idea what down payment assistance is or never have dealt with it. And the thing about down payment assistance is there's not, like you said before, there's not one place that you can go that houses all the down payment assistance programs.
Mhm.
So you really have to deal with somebody who gets their hands dirty with down payment assistance to know, okay, go over here, but not here. Go over here, not here. And also, Jeff didn't mention that we actually did a deal. I don't know if he remembers, where we got somebody close to $60,000 in down payment assistance. Close to $60,000 in down payment assistance. Do you recall as far as
I'm
what
not
that was
allowed.
going
I
to be?
mean, it was a pilot program, and we were reminded multiple times we're not allowed to talk about it. Like, otherwise, you would have seen me post it all day long. But they're like, it was a pilot program through PHFA. But the
Mhm.
problem is, like, they didn't want, like, loan officers were instructed we're not allowed to post anything. Some did and got in huge trouble and kicked out of the
Oh wow!
program. Like, it was
Oh
otherwise
wow!
that was an incredible pilot, and hopefully if they had the funds, like, make them, because again, like, that much in down payment assistance. I'll give you a side comparison. If you're looking at Montgomery County, currently they still have some extra money from COVID,
Okay.
because I got a referral and they're getting 30,000 plus the original 15. I'm like, where's the 30,000 coming from? I'm like, oh, it was leftover money from COVID. I'm like,
Nice.
God bless, that's 30,000 plus 50, that's 45,000.
All
And
right.
all they need is the minimum down payment. Like, they'll obviously increase the down payment, but you're right. But we did do a good job by that. I will say the other deal that you and I are working on, I'll give you a side comparison. Philly First, for example. You notice when you and I go into contract, I go right for that grant situation. I'm like, I know exactly what we need, and I harass everybody to get it right away so we have no delay. And I had a good realtor of mine. I knew both of them, buyer and seller's agent. They use another loan officer, the buyer's agent used another loan officer, but it was a disaster. Like, the
Mm.
listing agent, luckily she was well versed because her and I do a lot of business together. She had to quarterback to make sure that the buyer got the Philly First home documentation done properly.
Mm.
The listing agent, which is just wow. Because again, that's an opportunity. Like, if she didn't, the next phone call she would have got was, okay, listen, we can't close on the contract date. We're gonna need to now push it out to give extra time for the grant. That's just an example of, like, you need to work with the right people. Realtor, and I like this example. Mortgage, like, real estate is a series of handoffs. You got
Mm.
the realtor on the front line, they hand it off to the lender. Lender's got to work on it. There's an appraisal, then they hand it off to the title company. Like, it's a team effort, and
Yes.
everybody in that line has to be in sync. Because as
Yes.
soon as somebody in that is a chink in the chain, the whole thing can fall apart. If you have a
Right.
realtor that's not on board, you have a title company that's not responsive or quick, you have a loan officer that doesn't know, anybody in that equation will cause delay if they're not all working together. But I love that phrase. It's like, it's just a series of handoffs. In my
Right. Right.
job, I hand it off to my processor, who hands it off to an underwriter. It's a series of handoffs. The better I do my job, the better off your file will go. If the loan officer does a bad job documenting, etc., you might get a conditional commitment letter, but it's going to be a mile long. That's
Right.
not going to give anybody a lot of confidence. If I'm asking you for 100 things that we should have already had because I didn't do a good job up front. So I like that. That was my new favorite phrase I wanted to share. Series of
Yeah.
handoffs.
No. I've worked with lenders where I felt like I was the lender, and I'm following up, and it's just like, hey, I feel like I'm doing everybody's job, just so I can make sure that this closes. But that just me to my next question. Many buyers are unaware of how much money they could potentially receive from these programs. So could you talk about you've talked about it some, but just so in one segment, can you talk about the ranges of assistance that are available and how they can significantly lower the financial barriers to home ownership?
I think getting hooked up with a good housing counselor is definitely step one.
Okay.
Their job is literally to accumulate information from all available grants that are available, as well as knowing what lenders offer what kind of products. So if a housing counselor is working with you and they know your profile, they might be better suited to say, like, listen, like based on this and that, whether it's credit, whether it's income, whether it's assets, you might want to reach out to these lenders. They might have a better opportunity for you in terms of like, because you, again, like you said, you might have went down to your local bank. They might have pre-approved you, but that housing counselor might say, listen, like there's these grant opportunities. And like we said, every lender has a unique down payment and closing cost assistance program. So using them and leveraging that resource could definitely be beneficial. I think everybody should, one, go to housing counseling because that'll really give you a better indication of what home ownership really is.
Mm.
I mean, being prepared, creating a budget, like getting some kind of financial literacy, which from people that have closed, like they've seen people that have gone through housing counseling are substantially more likely to stay in the home than people that have not. Buying a home is not the same thing as renting a home. And if you're not prepared and you don't know the nuances, like that phone call I've gotten where my water heater's not working, who do I call? Like, who do you call? Not me. but I mean, like that's if you've been a renter all your life, you might be a first generation homeowner.
Right.
You might not know those things that are involved. Going to a housing counselor, they go through the whole process. They talk about budgeting, things that you might have been living a certain lifestyle, but listen, you want to own you want to have home ownership, you're going to need to cut a couple things out. So I mean, I would say like getting hooked up, like I said, a good housing counselor, not just like going through the motion, finding one that works with you.
Yeah, no, I definitely agree with I mean, but I think it's all around the board as far as getting somebody good, for the housing council, as far as the agent, because from my point of view, as far as the agent is going to quarterback everything. So if you have a bad agent and they're just kind of sitting around waiting for everybody else to do something, if somebody drops the ball, the agent really is the one that's going to have to pick it up. So if you have somebody that's not knowledgeable or somebody that's lazy or somebody who doesn't care, you may be in a world of hurt if the transaction doesn't go perfectly in every aspect of the game. And that's usually not the case. There's usually some ball that's dropped somewhere, or some type of oversight that the agent has to step in and kind of get the ball over the goal line, man. So, Jeff, finally, what advice would you give someone who's on the fence about pursuing home ownership because they feel financially unprepared? How can they take the first steps toward accessing the assistance that they need?
So one of two things. Step one, I would talk to a lender and go through the application process because some people are on the fence not knowing that they're eligible to purchase today. It's interesting because you have some people that are more qualified that are on the fence thinking they need more time. And you got people who are absolutely not ready, but they're applying everywhere to see what they can make happen. So it's an interesting dynamic there. But I mean, getting pre-approved is a really easy, simple process,
Right.
especially with technology that's available nowadays. I mean, it's convenient, it's quick. Considering that it's the biggest purchase of your life, you can literally do it on your mobile phone. Like I text somebody my mobile app, they could do it on their phone. I get the information, then I tell them exactly what I need. Like moments later, they give me that. I mean, it's quick turnaround. And then also like when you have that conversation, it might give you more confidence knowing like one, what does it actually cost to buy the home that you're looking for? There might be a neighborhood you want to be in, a certain type of house. You might be having a child. You might be upgrading or downgrading. Like you might be shocked at how affordable it is, especially, and I think we all know this, it is not cheaper to rent anymore. Like, especially if you're in the Philadelphia area, it's not cheaper. So you can't look at it from that regard.
Right.
And then the resources that are available once you go through housing counseling, which I think is like, I think some people do it to check a box, but if you actually invest in it and you go through housing counseling properly, meaning like you're not about to get on the contract, you already identified the house, you want to look for how do I make homeownership more affordable? Take advantage of it. Those are free resources. I don't know if we talked about that. It's free resources. Like it's not like you have to pay somebody to help you.
Right.
So, I mean, if you do the housing counseling part, I think that might help in talking to a good lender, interview them. Same thing with anybody in the transaction. You want to interview people. What you'll notice by talking to multiple people is you'll see how they talk to you, meaning, are they interested in you? Are they asking you the questions? And that's usually, believe it or not, I've learned that because when people would talk to me after they've shopped around, one, either I'm the only one that picked up the phone, or two, I ask more questions than anybody else. Either way, I win, but it's like, it's not because I offered anything unique. It's just they saw that I was vested in. I don't want to have a problem and have a conversation with you, the realtor, the listing agent, the buyer's agent, the title. Like, I don't want to explain to people I didn't do my job up front. We're not closing.
Right. Wow.
Which is why I said in the beginning, my job is to kill the deal. That means I ask all the questions to see, like, all right, what's not going to work here? Because I'm not trying to find out later. So hopefully, like if you're on the fence, and even if you've been pre-approved, shop it around. That's the one thing I'll tell you: shop it around, because you only know what you know. Shop it around. Use your realtor as a resource, same as a housing agent. Realtors usually know who's out there, who does what, but who will get you to the finish line. Having a great product but not being able to close, that doesn't help anybody, right? So
No, helps absolutely nobody, y'all. It wastes everybody's time. Trust me, trust me. Well, Jeff, where can they find you at?
So Fulton Mortgage Company. If you go to Fulton Bank's website, you can type me in by name, Jeffrey Vilk. You can find me on Facebook, Instagram. Um, Send a message through here. So usually, and hopefully, your realtor, whoever you talk to, already knows who I am.
Awesome. And this is Colin Nathan Alim, the real estate boss. If you're looking to buy a home, sell a home, or invest in real estate in Philadelphia or the surrounding counties, I got you. All right, guys, this has been another episode of fundyourkeys.com. Go to fundyourkeys.com to see if you're eligible or how much you're eligible in down payment assistance. All right, guys, until the next episode, take care.